Hey everyone, welcome to the show. Be the boss of your money. Here's what we know. The Fed raised rates to the highest level in 22 years. Stocks have been on a tear, in particular tech, and they do look a little tired. In particular, Microsoft down pretty big yesterday, and Meta, which is what Facebook is called now, popped in the morning and gave back a lot of its gain at the end. The Dow Jones was on a tear up 13 days in a row, and it just gave up the ghost at the end of the day. We could not go for day 14, in spite of really good news, a much better than expected GDP number, and good numbers all around from some big industrial type companies. So, what to make of it? That's what we're going to talk about. I'll be right back. We're going to roll the quick intro and we're going to wrap this up pretty fast because I got to get out of here. Here we go. All right, so the Fed just raised rates yesterday, and I'm going to call it a optimistic raise. The Fed has basically said they don't see a recession anytime this year. Employment picture is still looking solid. GDP came out higher than expected 2 quarters in a row. It's really hard to debate that we're having, look, we could debate this all day, but I don't see a recession on the horizon. We could talk about soft landing. There will be scares along the way. There will be days when things look bleak. There will be days when seemingly smart people get on the TV and say how bad things are going to be. And there are days when seemingly smart people get on the TV and say how good things are going to be. And you are left having to decide what to do next. That's what we do here. That's what we'll talk about real quick. So let's see what to take a look at. Fed raises rates highest in 22 years. There are 3 more meetings this year. There's one in September 20th, November 1st, and December 13th. Could the Fed raise rates again? Some people are saying the Fed needs to get one more rate hike in because they don't want to be having to hike rates right ahead of the next presidential election. I don't really think that has much to do with it. I don't think Powell is going to hold back if he needs to raise rates, Chairman Powell of the Federal Reserve. But basically, inflation numbers are coming down. The economy is slowing down just enough to take the top of inflation off. Even airline fares are starting to come down. Rents, equivalent rents, home prices, a lot of things are starting to come down in price. Used car prices are coming down. It's easy to see inflation coming down. It was 9% a year ago. It's about 3% now on the consumer price index. So does the Fed does it raise or not? What's really relevant is that the Fed always leaves the door open. It's data dependent. Every meeting is live, meaning at any meeting it could raise rates. Top people are saying the Fed is done. They really can't do much more. And they're letting about $100 billion of bonds off its balance sheet. Now, just so you know, there is about 31 or $32 trillion of treasury bonds in the world. Okay, that's our national debt. The Fed owns about 9 trillion, so about a third of that, almost a third. The Fed owns a lot. And that's one of the reasons why long-term rates, they own the treasuries. Fed owns long-term treasuries. That's one of the reasons why you are seeing the inverted yield curve. That's one of the reasons why long-term rates haven't really moved up, considering the inflation outlook. But by the time the Fed rolls more bonds off its balance sheet, the inflation outlook is already starting to look like it's coming under control. So I'm not overly worried about the inverted yield curve at this moment. On the other hand, consumers do have high credit card debt. People are borrowing a lot to pay bills. So look, we have a whole bunch of things to look at. But that is a concern. Highest credit card debt levels ever. And, okay. So Jess is out there. Hi, Dad. Keep up the amazing work. Thank you, sweetie. Greatly appreciate that. And a couple more things to take a look at. We have Fed's letting $95 billion of bonds run off its balance sheet. We went over GDP. Let's talk about what happened today with Facebook. Facebook was at one point at its new high. That's great. The stock was up a lot. It backed off. They raised guidance. For all intents and purposes, it was a spectacular quarter. What's happening now? We talked about this yesterday. It's hard to know when to sell a stock. And right now, nobody wants to sell a stock. Nobody wants to maybe buy a stock because you want to hold on to what you have. You don't want to give up any gains. You want to make as much money as possible in the market because you're going to need it. But you also have to be wary of risk. And the thing to do now, I think, is at the very least consider rebalancing your portfolio into an allocation that matches a risk tolerance based on your time horizon to when you're going to start to need the money. Does that make sense to you? Your time horizon is really what dictates your risk tolerance. And as you get closer to needing your money, let that be your guide. Let your personal finance be your guide. Don't be the one to decide, is Facebook or Nvidia up too much? Do they have to go down now? You're probably going to get it wrong. But let your personal finance decide. Do you have too much of your portfolio in one stock? If that stock goes down, how would it affect you? Do you have other stocks that are similar? Because if you have Amazon, Facebook, Microsoft, Nvidia, Netflix, etc., it's all like owning one stock. I know you think you're diversified, but they all trade up and down together. So if they're all correlated, it's like having all of your money into one thing. So when one goes down, they all go down. So that's the kind of thing that you need to look at. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And we talk about the major averages. You can't invest into an index, but you could invest in a security that tracks or mimics an index. We talked a little bit about artificial intelligence, and basically what that is, are we there yet? Are we making humanoid androids that are as good as people or that could really carry themselves in the world? And I say no. Right now, artificial intelligence is really a decision tree. If this happens, then that happens. If this happens, then that happens. It's back and forth. If these 10 things happen, then these 10 things, will be done next. So artificial intelligence right now is a really sophisticated, rapid decision tree, but it is not something where it has the human intelligence that you would expect from artificial intelligence that you're thinking. And we are a long way off of that. The whole point of the internet, which became bigger than anybody could have thought it would be, and yet internet stocks no longer really exist on their own, right? I think the same thing happens with artificial intelligence stocks. There are very few ways to play artificial intelligence. You've got the big software companies, Microsoft, Alphabet, which is Google, Facebook. You've got a chip company called Nvidia, but there are not a lot of ways to really play AI. There are a few smaller companies that are making waves in it. We'll see if they are the right ones or not. But when the sector gets hot, they do well. When the sector cools off, they cool down too. The whole point, like the internet, is that every company became an internet company. If you could look up a company on the internet, you could look at their products, maybe buy their products, order their products, send the money, reach them through their website. For all intents and purposes, that company is a internet company. So everybody's an internet company. And eventually everybody will be an artificial intelligence company. Target, Toyota, they will all be using artificial intelligence to sell more stuff. And I think that's where the artificial intelligence is going. Will it be an advantage to early movers? Yeah, I guess so. It'll be an advantage for that. But just like the internet, if everybody has internet access and being an internet company is an advantage, and if everybody has that advantage, then it's no longer a competitive advantage. And I think ultimately that's where we go with artificial intelligence. There's not a company in the world that's not going to somehow come up with an artificial intelligence strategy, and it'll be ubiquitous, just like the internet is today. But a lot of the AI stocks you see are probably going to disappear, just like you saw so many internet stocks disappear. It used to be that You wanted internet stocks. Well, you don't know who's going to be the big winner of the internet, but you want to buy the companies that sell the picks and shovels. And that was Cisco, it was Sun Microsystems, it was Lucent. And most of these companies have disappeared, or if they're doing okay now, they went down and stayed down for 15 to 20 years. Remember, the NASDAQ went down 80% in the year 2000 from peak to trough. It didn't bottom in 2000. I think it bottomed in 03. But it was a brutal, brutal time for anybody that owned tech stocks. You were losing money so fast, you didn't even know what to do. And you think, and the whole way down, pundits were saying, buy more here, buy more here. The internet's going to be huge. It's going to be bigger than anyone thinks. Correct. It doesn't mean the stocks make money. It just means that Walmart became an internet company. And, Walmart, it's okay. Hasn't been the most amazing stock in the last 20 years, but I think it's okay. As far as stock performance, it's not an explicit recommendation. All right. So that's all I wanted to say. Just a little bit of this, a little bit of that. Let's talk about the summer doldrums. That's the title of the broadcast. We have the Federal Reserve meeting out of the way. For the most part, the earnings season is almost over. It's been a pretty good earnings season. We've got Apple and a few other key companies that have yet to report. But by and large, it's pretty much over, and there's not a whole hell of a lot to look forward to. We've got Jackson Hole coming up next month. That's where the central bankers from all over the world get together in Jackson Hole, Wyoming. But we don't really expect any policy decisions to come out of that. Congress is about to go on their summer break, I think this weekend. Not a lot going on. Market is extended, and without fresh, really good news to keep the party going, stocks go into the doldrums and they start to drift lower. And I basically am calling it started today. Today was probably a short-term peak of enthusiasm for stocks. And I think all of a sudden investors are going to worry more about protecting gains than earning more gains. And without any Fed meetings or any major earnings announcements coming out, it's really hard to think about the market going higher now and becoming even more exciting. So get ready for a boring next couple of maybe 4 or 5 weeks. But I'll be here every day reporting on the news, letting you know what's going on, and most importantly, adding valuable perspective. I'm going to sign off. Follow me on social media, and have a great rest of the day. Have a great weekend, because I usually don't do these shows on Fridays. Okay? Bye.